Hey guys, so welcome back to the channel. Today I have a new trading strategy which I'm going to backtest for you. I will tell you about the indicators that we're going to be using, show you a few examples, and then perform the backtest. This strategy involves two trading indicators, the exponential moving average and the rate of change. An exponential moving average, also called an EMA, is a type of moving average that places a greater weight and significance on the most recent data points. The exponential moving average is also referred to as the exponentially weighted moving average. It reacts more significantly to recent price changes than a simple moving average, which applies an equal weight to all observations in the period. The rate of change is the speed at which a variable changes over a specific period of time. It is often used when speaking about momentum, and it can generally be expressed as a ratio between a change in one variable relative to a corresponding change in another. Graphically, the rate of change is represented by the slope of a line, and it's often illustrated by the Greek letter delta. So this backtest is based on the daily time frame on GBP USD with a rolling stop loss. So here's the strategy. We go long when the 7 EMA is above the 14 EMA and the rate of change becomes positive. And we go short when the 7 EMA is below the 14 EMA and the rate of change becomes negative. We place the stop loss at the last swing. We don't have a maximum number of trades that we can have at any given time. And when the open profit reaches 1R, we move the stop loss by 1R in the direction of the trade. So let's get on the charts now so I can show you a few examples and then we'll dive into the 100 trade backtest. All right, so here we are on the charts. We've got the GBP USD on the daily time frame. We'll go ahead and add the indicators. So we've got two exponential moving averages and one rate of change. So one of the EMA will be 7 and the second EMA is going to be 14. We'll change the color so that it's obvious. Let's say to blue, and then the rate of change settings will remain the same. However, I like it light gray like this. Change the thickness. Essentially, when the white line, which is the 7 EMA, is below the blue line, we're looking for short positions. And during that time, we're looking for the rate of change moving from being positive to being negative. And similarly, for long positions, the 7 EMA needs to be above the 14 EMA, and the rate of change needs to move from being negative to positive. So I'll show you a few trade examples and then we'll dive straight into the backtest. So here are perfect examples of long trades. We've got the 7 EMA above the 14 EMA, the rate of change turning negative and then straight away becoming positive. So we take a long. We place the stop loss at the last swing, which is here, or even it would have been here. And then we ride all the way to this, which, as you can see, is a 1:9 risk to reward ratio. So you would have moved your stop loss as far as 1:1, and then you would have been stopped out for a 1:1 risk to reward ratio right here. Similarly, for this one, we've got the conditions. The rate of change becomes positive. We take a long, we place the stop loss at the last swing right here. And same here, we reached a maximum of 1:2.14. So we would have been stopped out at 1:1 right here. And here are some short trades examples. You've got the conditions here. The 7 EMA is below 14 EMA. The rate of change becomes negative. So we take a short, a stop loss at the last swing. Here is a loss. So it's a losing trade. Right here, same thing. It's a break-even trade simply because you would have reached a 1:174. So you would have moved your stop loss to break even, but nothing beyond. So this would have been a break-even trade. And this one right here is a winning trade at 1:3 risk to reward ratio. And as you can see, you would have reached a maximum of 1:416. So you would have moved your stop loss to 1:3 maximum, and then you would have been closed out right here. So let's do the back test right now, and then I'll see you for the results. So there you go, guys, the results on GBP USD. We had a maximum drawdown of 37%. We were risking 5% per trade with a variable risk to reward ratio. We had 22 wins, 33 losses, and 22 break-even trades. We had a maximum of 5 wins in a row and 3 losses in a row. So that gives us a win rate of 40%. So the total profit is 88.4% on the account. So if you would have started with $10,000, you would have ended up with $18,844 after 2,640 days, which is about 7 years. So as you can see from the chart, the drawdown is quite high. This strategy works best in trending markets. So that means that on the daily time frame, in certain economic environments, the volatility is really high. So you're making some losses over a period of time, and then suddenly a large trend builds up, and then this is why at certain points we've got large wins which outweigh all of the other losses. So it could be a good idea to test this strategy on the lower time frame so that we've got more sample data. Let me know what you guys think in the comments, and I'll see you in the next video.